You open up your portfolio, some coins are up, some are down, and others, they've been deep in the red for so long, you stop checking. Those losses, they might actually be your best shot at tax savings this year if you act before the end of December. It's called tax loss harvesting. And yes, it applies to crypto in Canada. But if you do it wrong, you could miss out on a tax break or worse, trigger CRA penalties. Hi, I'm Charlene Tessier, your Canadian crypto tax expert. And today I'm breaking down what TD, Fidelity, Questrade, and Intuit all say about tax loss harvesting, but through a crypto lens so you know exactly how to use it before the December 31st deadline hits. Every September, I am asked the same question, and it is, can I use crypto losses to reduce my tax bill? The short answer, yes. But there's a catch. Actually, several. The CRA hasn't released crypto specific tax loss harvesting rules, but the major financial platforms, TD, Fidelity, Questrade, and Intuit, have all laid out the basics, but mostly for traditional stocks and mutual funds. So in this video, I'm not just going to summarize what they said, I'm filtering it through a Canadian crypto lens so you know how to apply it to your BTC, ETH, altcoins, and even NFTs. Before we dive into the how-tos, here's one thing you need to understand. Tax loss harvesting isn't new, but every Q4 it makes a comeback. Why? Because timing is everything. Miss the deadline and you miss your chance to save. Well, until next year. So let's talk about how this strategy actually works. You sell an asset that's dropped in value, and that loss can offset capital gains elsewhere, reducing your tax bill. It's like giving your losing trades one last job to do. So how does it work with crypto? In Canada, crypto is treated as a commodity for tax purposes, not legal tender. So when you sell, trade, spend, that's a taxable event. And in most casual investing situations, which is probably you, it's treated as a capital gain or a capital loss. And in 2025, the capital gains inclusion rate is still 50%, which means only half of your net gains are taxable. So if you make 10,000 in gains, you're only taxed on 5,000. If you realize 5,000 in losses, that cuts your gains in half and slashes your tax bill. Have you got some NFTs collecting some digital dust that might be your tax saving move of the year? But wait, don't jump the gun. There's one rule that trips up people every time. It's called the superficial loss rule. And here's what it says. If you sell a crypto asset at a loss and you or someone affiliated with you buys or has the right to buy that same identical property during the period starting 30 days before the sale and ending 30 days after your loss is denied. And that's a 61-day window you have to stay clear of. No tax benefit, just a missed opportunity. And yes, this does apply to crypto. Even though each token is technically unique, the CRA treats them as identical property under this rule. So what does this mean in plain English for you? Well, let's say you buy some Bitcoin on October the 1st and you sell it at a loss on October the 20th. Now you buy it back again on November the 5th. Even though your loss is real, the CRA won't let you claim it because you bought it within 31 days before the sale. And you bought it again within 30 days after. And you are still holding that asset after the sale. So that entire 61-day window counts and your loss gets marked as superficial. So what's the fix? If you're planning to harvest a loss, don't rebuy the same token for at least 31 days after you sell. And of course, avoid buying it in the 30 days before the sale if you plan to sell it in that window. So here are a few key things you really need to keep in mind about tax loss harvesting. You can only use capital loss to offset capital gains, not your employment or business income. If you have more losses than gains, you can carry them back 3 years or forward indefinitely. And yes, tax loss harvesting only works if you have gains to offset. No gains, no benefits. Now that you know how these rules work, let's see how this looks when you apply them. I would like to introduce you to Tim. And a few years back, he decided to buy $25,000 worth of altcoin. And they have actually dropped to $10,000. And this year he's decided, I am going to dump these coins. So he's now locked in his capital loss of $15,000. But Tim also wants to take a year off to travel. So he decides he's going to sell some of the Bitcoin that he originally bought for $10,000. And it's currently worth $30,000. So he's going to realize a gain of $20,000 this year. He's going to apply that $15,000 loss to offset the gain, and he's going to be left with a net capital of $5,000 to report. Remember, though, you're not taxed on the full $5K, only half thanks to the capital inclusion rate. So he'll be taxed on $2,500. Now compare that to skipping tax loss harvesting, and he would have to owe on the full $10,000. And that is a big difference. Tax loss harvesting isn't just about losses, it's about strategy. Look, the strategy, it isn't magic. It's timing. It's knowing what the CRA counts as a valid loss, and it's about using your crypto losses legally and intelligently. And that's what I do every week. I help Canadian crypto investors like you simplify the noise, stay compliant, and keep more of what you earn. Are you thinking about trying tax loss harvesting this year, but you still have questions about whether it applies to your portfolio? Drop them in the comments. I read and respond to everyone. And if you want to stay ahead of crypto tax changes without getting overwhelmed, I would like to invite you to my Sats and Coffee weekly newsletter. It's where I answer the 15 most asked crypto tax questions by Canadians. And I give you tips and strategies just like this every week direct to your inbox. Link in the description. Well, till next time, here's to more profits minus the tax stress. See you in the next video.